If we're correct about the environment, we think the 10-year will get to 375 next year. And like I said before, the S&P up 12% or so from here. Then in that environment, if you want fixed income, if you care about income and stability, then you want to be in the riskier parts of fixed income. And so that's high yield bonds, BNDS is our fund there, and preferreds, and PFFA is our fund on the preferred side.
I'm your host, Melanie Schaefer. Welcome to Lead Lag Live. Now, markets just got another major single, and that's not just in the pullback. The U.S. monetary base contracted again in September to about $5.48 trillion, the lowest in over a year, while the Fed recently cut rates to around 3.754%, but warned that future easing isn't guaranteed. With AI capital spending heating up and investors searching for yield, this is shaping up to be a defining moment for income strategies, bonds, and dividend stocks. My guest today is Jay Hatfield, CEO of Infrastructure Capital Advisors and the manager of ICAP, PFFA, and BNDS, among other ETFs. Jay, it's great to have you back.
Thanks, Melanie. It's great to be on.
Now, can you start by telling us a little bit about what's going in the market right now with this pullback following earnings?
We had actually expected a pullback for really two reasons. One, you already mentioned, it's totally normal to have pullbacks when earnings season ends. Everybody knows the May pullback and the September pullback, but there's also usually one in somewhere in February and then also in mid-November like we're in now. So the reason for it is there's no real catalyst, positive catalyst for stocks. And so the only thing, so all the good news comes from companies. Bad news comes from everything else, including short sellers who come up with the new reason that, tech's in a bubble or that there's an accounting problem, etc. And stocks are vulnerable to that because companies can't report earnings and, put out positive information. So they're just stuck, listening to the short thesis come out. So that's kind of the first factor. But second one factor is more substantive, which is, we have a 7,000 target on the S&P, but that's quite a full target. So targets aren't just meant to promote stocks and say, oh, we've got, we like this stock, we've got a 200 target is trading at 100. It's meant to also sell it when it gets to the target. So we got right up to close to our target at 69.40. And then we saw a fade off that, which makes all the sense in the world. And particularly what's really driving that 69.40 number is really tech stocks. And in our models, all of the Mag 8 are pretty fully valued. We think Amazon's pretty reasonably valued, but the rest, Tesla's wildly overvalued. So as a group, they're fully valued. And so that's where most of the selling is occurring. There will be certain days like today, which is more like a flush, what we call flush. So instead of there being a ton of rotation between tech and value, old economy stocks, income stocks, it's just everything gets sold, which is pretty much what's happening today. But usually because people are bullish about this market, it's more of a rotation, which is what was happening yesterday. But, makes all sense in the world. Not a tech bubble, but definitely full valuation, perfectly reasonable to take profits.
So do you see tech then continuing to pull back into people are going to be looking forward to that Santa rally to December?
We think that it'll bounce pretty, have periodic bounces like it already has. There are a lot of dip buyers. Some of the most stocks might keep going down, but the other stocks, they come down enough, then they're not fully valued anymore. So And, I have a lot of friends in Silicon Valley. They're ready to pounce when these stocks come in because they've made a ton of money owning them in the long run. So we don't think it's probably not even a tradable pullback. So not one to panic about. And, our target is entirely relevant at 7,000, but we're only a month or so away from the year end. And we have a 7,700 target for next year. So that argues for not completely bailing out of all their stocks. Most of the time, when investors bail out, they don't get back in fast enough. It's not a great long-term strategy. So, it's perfectly reasonable, raise a little cash, maybe try to put it to work at lower levels or at least in more reasonably priced stocks. But we don't think it's a panic. And like I said, it's totally expected. So it's not coming out of the blue. I talked to my research team during the week of all the 5 of the 8 mag companies reporting, greater than $1 trillion companies reporting. And we expected the following week to have a pullback, which we had last week and we're continuing in this week.
Yeah, so there you just mentioned rotation and better valued stocks. And I know SCAP is one of the ETFs that you have. Can you talk a little bit about where you see small caps going? And will there be rotation coming into that?
Yeah, so what a lot of people don't appreciate is small caps are just part of the rotation trade. They're particularly we invest in the value portion of it, and that's only about 10% tech, which is even less than equal weight S&P. So it is a rotation asset class, and typically stocks do rotate when we come out of a Fed tightening cycle. So in other words, when the Fed's loosening, which they're hemming and hawing about it, but they almost certainly will cut 4 times over the next year, particularly when there's a new Fed chair who knows what he's doing. And so it's only a matter of when, not if. So we do think that small caps will outperform. But having said that, we think tech stocks will do fine. They may not outperform their risk. They are like twice as risky as the market. So if you care about risk, we do think it's a good time to rotate into small caps. ICAPs are large cap dividend fund, sort of funds that are more correlated with the Dow and the equal weight S&P and less with the NASDAQ and the S&P.
Yeah, so just there you mentioned rate cuts. You've been vocal about the opportunity as well in corporate bonds through BNDES and preferreds through PFFA. So especially with the rates likely to move lower in 2026, as you say, why do you think now's the time to position for yield? And how are you thinking about credit and call risk in this setup?
Well, so it's important to draw that distinction when you're investing in fixed income versus equity. Fixed income, senior to common, you get paid first, safer than equities. But if we're correct about the environment, we think the 10-year will get to 375 next year. And like I said before, the S&P up 12% or so from here. Then in that environment, you want to be if you want fixed income, to care about income and stability, then you want to be in the riskier parts of fixed income. And so that's high yield bonds, BNDES is our fund there, and preferreds, and PFFA is our fund on the preferred side. And I would argue that even in the long run, it's particularly a good time to be in those asset classes now. And also it's rewarding on days like today where market's way down because preferreds and bonds do way better than the market. Of course, when the market's way down, it's better to be in the lower risk bonds, but we think in the long run, they'll go back up. But the great thing about these riskier asset classes, they're going to move around with the market and what have you. But in the long run, they're likely, no guarantees, but likely to produce total returns pretty close to their coupon. So in that case, BNDES yields 8, PFFA 9+. So you're going to get it returns. You have fixed income. You have that senior to common safety and lower volatility, but you've got returns and even income, actually, in this case, that are in the zip code of equities, not usually as good as equities, but in the right zip code as equities. And so we think that that's a good long-term place to be as well, because as you move through cycles, you still get this pretty, high single-digit total return.
Can you talk a little bit specifically about the monetary contraction that has some investors, at least, on edge, and how you interpret that in terms of growth and rate expectations heading into next year?
Well, we think the biggest mistake the Fed makes, and many other investors, is they ignore the money supply. The Fed chair has said that publicly, so I've been highly critical of him and compared him to, it's like having a pope who doesn't believe in Jesus. And so the Fed ignored the money supply to their peril during the monetary expansion of the pandemic. And Milton Friedman's theory of inflation was proved 100% correct. So if the Fed increased the money supply 60%, nominal GDP grew 38, and inflation was 22%. So that's exactly what he would have predicted. And now, though, we have the reverse. The Fed's been so tight. So to keep rates tight, the Fed has to modify the money supply, basically bank reserves plus currency. And so they had to shrink that. That's just indicative, like some Fed members who are, as a group, incompetent say that, we're not that restrictive, but that's just false. They're having to shrink the money supply by about 7% a year over year, to keep rates as high as they are now. They should grow the money supply in line with nominal GDP, which would be positive 5. So they've shrunk the money supply. That means inflation is going to continue to come down. It'll happen slowly because the BLS is inefficient about measuring it. But so it means we're definitely going to have a Fed cuts going forward. It'll take the current Fed a while to figure out that they should do that, particularly with this information blackout and also continued noise in these CPI figures. They need to redo CPI. Should also modify their target, because their target's way too precise at 2. It's particularly precise given the fact that CPI is so poorly calculated. So they're treating CPI like it's some scientific calculation when it's just a very rough estimate that is obviously highly delayed. That's why we put out our own index that's a leading indicator of CPI. But that inefficiency will clear up when a new Fed takes over and get rid of the current incompetent Federal Reserve.
Yeah, and I know you've been very vocal about that, and that also got you quoted by President Trump, who's obviously been listening and watching you and what you have to say. I just want to pivot now, Jay, and talk about AI. I mean, that's another big theme that you've been talking about, not just as a tech story, but as a productivity and capital formation story. How does that influence your portfolio positioning, and which sectors do you see benefiting the most?
Mm-hmm. Well, we correctly predicted that the AI boom would benefit investment banks. So we bid big in investment banks. There's certain REITs like Kilroy that has office space in San Francisco. Boston Properties has office space all over the country, mostly in gateway cities. And those companies have done well. All the investment banks, not just Goldman, but Morgan Stanley, Bank of America, et cetera. And now we're recommending private equity firms, which have traded off, we think, irrationally because of fears about credit, which those fears we think are wholly overstated, would have been relevant in early 22 going into a Fed's tightening cycle. There's a little bit of problems in the auto sector, so it wouldn't go rush in by CLO based on auto loans, certainly. But these private equity firms don't have a lot of exposure to that asset class. They have higher quality counterparties, so they didn't get caught up in the fraud, a couple of fraudulent situations. It's not even their capital. So if they do take losses, they don't want to lose their clients' capital, but it's not their capital. Most of it's not their capital. So huge opportunity right now in the private equity firms. So, it continues to be, and getting back to AI, there's the IPO boom and merger boom. It's going to benefit these companies. They're going to have realizations. So they should have very strong earnings over the next couple of quarters as these IPOs come out and they get proceeds. That's great for their business. They book earnings, but they give the capital back to their clients, and then the clients have more capital to reinvest in their future funds.
Yeah, and you mentioned briefly about ICAP. What's the advantage of leaning on dividend names right now, considering the state of the market, and how should ICAP fit into people's portfolio?
Well, so ICAP is a good example of not having all your eggs in one basket. So today is a horrible day in the NASDAQ. It's down over 2%, but the equal weight S&P is only down 75 basis points. And so that's the closer the return you're going to get with these dividend funds. And then we do enhance the income and total return by writing individual calls on stocks that we think are fully valued where we have a gain. That's the only kind of call writing we favor. And that's proven to be a very attractive strategy. And if you look on our website, you can see the returns, see that we've beaten all the benchmarks pretty substantially. Verify all that with real data. But a lot of it's driven by some of these picks we've been talking about, taking the derivative plays on AI, but also by just continuing to grind out these returns, writing very short-term calls on fully valued companies.
You don't expect the Fed to cut in December. If they do, what will change, or will that change anything for your predictions for 2026?
Well, as I mentioned, the real critical dynamic is that they do just cut rates 100 basis points over the next year. And the reason for that is the 10-year trades almost exactly 100 basis points over the terminal Fed funds rate, so the rate that the Fed's going to get to. And the 10-year is what drives the 30-year mortgage, and the 30-year mortgage drives housing, and housing drives most cycles. It did not cause a recession, even though that sector is in recession, as is construction. We didn't have a cycle this time, partly because we never had a huge boom in housing because of the great financial crisis, but mostly because of the AI boom. This is a very unique boom in that it didn't just drive spending in software, et cetera, but also drove spending in data centers and electricity. So it has an old economy component, and that's kept the employment market relatively stable. It's contracting, but quite stable, and kept consumer spending on track, although slowing. So as long as we get the cuts, and we still have a shot at getting a cut, because now that the government's reopened, we're going to get November's employment report. And this Fed, they're all Keynesians, which is really, in our view, more of a political philosophy than economics, because it doesn't really predict the economy at all. But Keynesians are focused on the labor market. Labor market's weakening, they'll cut rates. So if we get a very weak report at the end of this month, before the Fed meeting, then we could get a cut. But right now, our base case is we don't have a cut. And that's what the Fed speak is indicating, is no cut right now.
Well, Jay, as always, fantastic information, ideas, et cetera, for advisors and for investors. For those who want to put these ideas to work, whether it's yield, preferreds, or dividends, small caps, et cetera, what's the best way for them to get started, and where can they go to find out more about your strategy?
I would recommend signing up on our mailing list on infracapfunds.com. You get our economic research, also our fund research. And then you can sign up for a webinar and ask questions and hear our economic outlook. So infracapfunds.com.
Great. Well, Jay, thanks so much for joining me. And thanks to everyone for watching. Be sure to like, share, and subscribe for more episodes of Lead Like Live.